The broadcast is now starting. All attendees are in listen-only mode.
Good evening, guests and members. Welcome to the International Model Stock Investment Club April meeting. We are a better investing model club open to the public. A model club's primary role is to be a learning lab for attendees to learn both better investing principles of fundamental stock investment using the online stock selection guide, and also to learn investment club operations management. And hopefully through these meetings, we can demonstrate these two things. Our meetings are held on the third Monday of each month at this time, the exception being December, when we meet on the second Monday of the month because of the holidays. All our meetings and stock studies are held online, allowing us to have members from around the world. Our current members are from the United States, Canada, and China. Guests, as observers, you're going to be muted during the meeting, but you will have an opportunity for questions and comments once the meeting ends. Any companies that we mention today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. And we may mention during this meeting some products or services not endorsed by Better Investing or the club. And the views expressed are those of our members and don't necessarily represent those of Better Investing. I would like to let you know that the meeting is also being recorded and will be posted to our YouTube channel for future use. So with that, we will begin. First, I'd like to introduce Henry Gold. Henry is joining us today in the capacity of a mentor. We periodically ask more experienced members of Better Investing to join our meeting and some feedback on how we're doing and how we can improve. So Henry started investing in stocks when he was 17, and he's used his experience to help others achieve their financial goals. I think Henry's 35, so he's only been doing this for a few years. He's written and presented workshops for high schools, libraries, and the San Francisco chapter for approximately 20 years. And he also presented a variety of financial workshops for other organizations that are dedicated to teaching financial literacy. Henry has been a member of Better Investing since 1996 and joined the San Francisco chapter board in 2000 and was president of the chapter. In 2013 and 14, he was co-chair of the Better Investing National Convention and chair of BINC 2015 and 16. He became a director of the Better Investing Volunteer Advisory Board in 2013 and chair in 2019. So Henry, thank you for coming and a warm welcome. Now, I think that I don't know, is Tom, yeah, Tom Jones is here. So Tom, I'm going to pass it to you.
I'm here. You want to give me the screen?
I will, if you could please do the treasurer's report. So
certainly.
Thank you.
Now this is, let's see, from current slide. Okay, this is kind of an abbreviated edition of the treasurer's report. There's a more complete one. I sent out a link. I believe it was yesterday. It's on the Google Drive. This is our. Where do I move this thing around here? Get it out of the way. Okay. This is the stocks in the portfolio currently, and they're the gains and losses, the losses that we have on all of them. Yes, okay. I guess the best performing is Schwab at this point. and IPR is second place. The worst performer is Kirkland. And so well, Manifest recommends selling stocks that are lagging the market by 20% or considering selling them. So of our stocks here over the past 12 months, S&P 500 gained 51.91%, but that's, those returns are a little bit juiced or outsized here because of the market crash in late March of last year, and then there was a rebound. So anyway, these S&P was almost 52%. So all these here in the red box are more than 20% trailing the market on a 12-month basis. But this doesn't have anything to do with our holding time or anything like that. This is just a snapshot of 12 months. And I thought one thing, I was looking at the different charts and things. One thing, a stock here that in Inogen looked interesting to me. That it's short. I think this might be a little bit out of order, but it said recent performance has really shot up here over the last couple weeks. I don't know if things, how long the trend will turn, but if you go by this relative strength, which has to do with how fast the price is changing, it's 83. I think that's about the highest I've seen. I guess they had another big enthusiasm, but that's pretty wild recent performance. But it got way down here back in November, December. So these are the sectors over the past 5 years, or pardon me, over the last 1 year, or 12 months. Materials was the best, and utilities was the worst. But again, a lot of these are have to do with the market crash and how much they bounced back. Energy was #1 last month. And so if you take a 5-year return, this is kind of more what I think a person would expect, as far as returns. This is an annualized return, and which sectors have performed the best. This over here, this 12 month is kind of crazy. So anyway, these are the sector performance over the past 12 months, and these are the club allocation to these various sectors. Our largest allocation is to the communication sector because we have quite a bit of Facebook, and then also Disney and Comcast. And then the technology sector, one thing I thought interesting here, Qualys has just been kind of flat. But if you look at if you look at 12 months, but if you go back 12 months where this red mark is, there's not much change, but it's been pretty volatile throughout the 12 months. So this is what Manifest projects are by their methodology, what they think the potential return is annualized on the various stocks in our portfolio. These stocks here in the red box, they're projecting that are less than their my par. This is the average of all the stocks that they cover. I don't know, maybe like a couple thousand. And then the sweet spot would be like 5 to 10% above that. So the green ones are in the sweet spot. The yellow ones are caution. And then the ones circled in red here they're projecting to be laggards. This is the stocks in the portfolio sorted by price to Morningstar fair value. Morningstar they do what discount cash flow analysis, and they create a value for what they think each stock, a fair value for what they think each stock should be. And they think, I guess, BioMarin, Vertex, Facebook, and Inogen are possibly a little bit undervalued, and then the rest are fair value or somewhat overvalued. This is our allocation by size. We've got about 15 in small, about 30 or 26 in mid, and then almost 30 in mega, and then 29% cash. And then here's another chart and the stocks that are in those sectors. So that's that concludes.
Oh, thank you, Tom. Thank you.
I guess take it away, Henny.
Okay. So the next item on our agenda is the portfolio review. So Tom Loftus, if you want to, if you're ready to go.
Yes. Okay, so the portfolio review is based on and on the PERT. And so the PERT is generated by the BISSD, and then all the information with how many shares we own is put in, and then the cash and the scans are done. So when we start off doing diversification, we're talking about the size of the revenue, the number of sectors that we own, and the largest and the stocks we own, and the number of stocks we own, and all the in diversification. We're pretty well diversified. The only issue we have with diversification is that we have too much cash against the target. The BI target is 5%. We have 29%. And the stock study group is going to present a couple of stocks this evening, which will hopefully bring down that high cash level. Whenever we look at quality, we're looking for quality companies and confirming that we do hold quality companies. This screen is to look and check that are these companies are showing traits which may raise a question as to whether they are quality companies or not. They missed their estimates. And Inogen, BioMarin, FleetCor, Schwab. Schwab is going to be challenged this evening by two financial retail. So again, we're picking up some things we found over, like this was identified last month, and we're picking it up this month to correct that. So if we look at the value of our portfolio, we're looking to which stocks identified as buy low opportunities. And last month, we also identified Algonquin as a low, as a opportunity to buy. At that time, Joanne thought the debt was too much and didn't want to buy. So if we move on to the opportunity to sell high, we have FleetCor, Kirkland Lake. Hanny's going to present that this evening. BioMarin. Tom reminded us that this is a speculative stock, and it's not conformed to the BI rule, so it's not surprising that it's BI screens have identified it that way. And but he thinks that the company's okay. It's as presented when we did the buy. He thinks it's performing to that. And then Inogen, and Pero has issued a sell hold check sheet recommending a sell. So on performance, we're meeting our objective for the portfolio in the past. We've achieved in excess of 15%. Our future of our total return for the future is at 8.4. So this is the area where we are trying to raise. We've raised it over the last few months from 6 to 8.4. So that is good. And I think that's the short version. We just need a confirmation from Joanne and Jay that their companies are still holds. They still feel it that way, and the other things will be covered in the rest of the meeting.
Okay, thank you very much, Tom.
Okay.
So next on the agenda is our education topic, and John Catterson is going to be presenting Bitcoin. So take it away, John.
Hello, everyone. Let me get this going here. Okay, so I'm going to go for 15 minutes. Probably not going to have any time for questions, but you can put them in the portal, in the panel, questions or chat, and members can email me later. So Bitcoin basics. Bitcoin is a networked, software-based, internet-native solution for money. It's totally inadequate, but it's the one-sentence definition you can give. So money systems are ledgers, gold, and what the Bitcoiners call fiat-based systems. Fiat is like US dollar, pound, euro, yen, government currencies. They're tracked. Government is the third party that tracks, and they've succumbed to the temptation of seigniorage, which is a fancy term for the money is much, much, much more valuable than the cost it takes to print it or to generate it. So they print more, even if they shouldn't. So Bitcoin does not allow double spends with digital money. So double spends and copying of a digital money would kill the scarcity for fraud. So that was a problem for probably 20 or 30 years, trying to figure out how to fix that. Banks use digital money, but they're the trusted third party again. They're the trusted third party. Bitcoin employed a decentralized network where everyone has the ledger. So everyone has a copy of the ledger and verifies with everyone else what is the actual money in existence. Bitcoin cryptography uses ECDSA, that's elliptic curve digital signature algorithm. Now what the basics of this, I don't know the details of this, but the basics of this is that for any output in this ECDSA, it is easy to verify that the input is correct, but if you don't know the input, it's super hard to find it. So to give an analogy, there's a very, very, very secure door, and there are many keys you can use to try to open up the door. You have to use the keys one by one by one by one. The only problem is that the size of the pile of keys is the size of the Milky Way galaxy. So it's incredibly large number of keys. You got to try one by one by one. So current computers, as of today, can't do this easily, this ECDSA, if it's set up that way. They may be able to in the future, especially with quantum computing, but not right now. So Bitcoin uses the SHA-256 hash function, number 5. That's SHA-256. It takes any input and provides 64 alphanumeric characters as the output. So you could have an input of ABC, and you get an output of 64 alphanumeric characters. You could put an input of 1,000,000 characters, and you get an output of 64 characters. And that should hopefully make a little more sense as to what that means for Bitcoin. With the next slide. Okay, Bitcoin mining. So obviously they're not really mining, but blocks are sets of transactions, and they're added to the Bitcoin ledger. These miners are really just verifying transactions. So a miner uses SHA-256 a couple times actually, but then tries to find an output when they use it at the end of their trying to do the mining, getting the block added, with a number of leading zeros. And you could say like 20 leading zeros. So remember, there's 64 characters, and they're trying to generate an output with 20, for example, leading zeros. So that's going to be pretty rare. It's going to be hard to find. It's going to take a while to generate and grab. And there's multiple miners competing to do this. And so finding this output is computationally intense. It takes work, it takes electricity actually, and mining rigs. As a reward, the miners granted 6.25 Bitcoins and the fees and the transactions in the block. So this next slide, I actually, as we got closer and closer, meaning like in the last 2 hours, I thought about changing this one, but it's a little bit too late. But this is about how Bitcoin is a mutable ledger, which means immutable means unable to be changed. So that's as a statement, opinion, immutable money is good. Theft, account freezes, and excessive government printing can harm monetary ledgers. So Bitcoin's ledger is immutable because a large actor can be opposed by other actors. So anyone can join to mine Bitcoin. Anyone can participate and overwhelm a large actor trying to do something bad to the protocol. Miners need costly equipment that is just for BTC. So these mining rigs, the only thing they work for is BTC. They're expensive to assemble, and so you waste a lot of money if you're just trying to harm Bitcoin. Buying these rigs, creating these rigs. And the last one, the attacker must attack constantly. Mining is costly, and the attack would lower the value of BTC. So of course, this would disincentivize attackers from doing it. Charlie Munger once said, "Show me the incentive, and I will show you the outcome." So now here's the heart. This is going to take a while in this presentation. But the Bitcoin these are 11 characteristics of good money. I got this from a book. He had 14 characteristics, and he had slightly different ratings for some of the ones, but I changed the rating on some of these. But here we go with Bitcoin. And the reason I am doing this is because some people say that Bitcoin is not backed by anything, and that's true as they mean it. It's not backed by the government. It's not backed by the full faith and credit of the U.S. government or the Chinese government or the Canadian government. But what it's backed by, what all currencies are ultimately backed by, all currencies and monies are ultimately backed by, is the belief of the users in those currencies. If the U.S. goes into a hyperinflationary spiral, no one's going to care about the full faith and credit of the United States government. It's going to be about what gets me my goods that I need to survive. So this is about the characteristics of a good money. Number one, identifiable. You must be able to identify valid money as valid money. So Bitcoin has a decentralized system of computers that tracks money, tracks Bitcoin, and utilizes cryptography to secure it. So the nodes, who are just computers that verify transactions, and the miners would be able to tell when money is not valid, when not a valid money. Transferable, 4 out of 5. So you must be able to transfer money from person to person or from business to business to use it as a medium of exchange. Bitcoin can be moved anywhere in the world, from anywhere in the world to anywhere in the world in under an hour. But a large amount of Bitcoin can be moved that way. But Bitcoin wallets are kind of a pain in the butt right now, and the fees can be high, but wallets will get easier and easier as time goes by, and it could reduce with the Lightning Network, which I don't have time to go into, but they might reduce because of that. 3 is durable, 4 out of 5. This is about transacting over space and time. You don't want to have a perishable good as a money. So Bitcoin is on over 10,000 computers worldwide. However, it is dependent upon the internet. But if the internet is the global internet is unlikely to go down for a long time. If it does, you don't have to worry about Bitcoin and US dollar. You need to worry about guns and ammunition because it's a zombie apocalypse at that point. So that's what I think about that. 4 is divisible. This is for scale to get small. You want it to be small for small transactions. You want it to be able to be small for precise amounts on large transactions. Bitcoin could be divided into up to 8 decimal places. So 0.0000, etc. 1 is a Bitcoin. 8 decimal places into what's called a Satoshi. There are 100 million Satoshis for every Bitcoin. If a Bitcoin is worth $1 million US, Satoshi will be worth 1 cent. So it's still very, very divisible. Scarce is 5 out of 5. Obviously, you don't want the money to be able to be created easily, because then people will just create the money as their main occupation and try to dilute the money and use it, and that will ruin the money. So Bitcoin is limited to 21 million Bitcoins. That's what's in the protocol. That's what the miners and the nodes and the network operators have agreed upon. And And I was going to say something else, but I forgot, so I'll move on. So short-term stable value is 1 out of 5. That's a low point for Bitcoin because it experiences short-term gyrations in the price, which of course lowers exchange value. Bitcoin just moved over the weekend down 10%, I believe, or maybe a little bit more when it dropped. Actually, the full drop, it rocketed right back up from the full drop, but it was more than 10%. So, but the volatility has decreased over time. However, because of the scarcity, because of the fixed issuance schedule, which Bitcoin has, there's no supply cushion. There's no ability to mine more Bitcoin if there's more demand. So there will always be some short-term volatility in Bitcoin, but it could go higher than 1 of 5. It could be up to 3 of 5. So now long-term stable value, 3 of 5 right now. So Bitcoin is non-inflationary, so it should go up over time. It has gone down 80% in 1 year, well, in multiple 1 years. It's gone down 80% in a year, but over every 4-year period, it's gone up substantially. So it goes up over time. It goes up. That's the short history of about 10 years. So we'll see how it does in the future. This could go up further in time as we see how Bitcoin does. Fungible. That means the money is the money is the money. Each piece of money is the same as the other piece of money. So usually a Bitcoin is a Bitcoin is a Bitcoin, but there are blacklisted addresses by governments. So those are prevent people from using Bitcoin in certain governments, certain countries. So that's 4 out of 5. Private, 2 out of 5. This might be surprising to some people who think that Bitcoin is used for crime, but it is used for crime foolishly by the criminals because every transaction is associated with an address. Keys can be anonymous, but the owner can usually be identified, by the FBI through the address checking and doing that kind of stuff. So it's not good for crime. If you want to do crime, don't use Bitcoin. Required by a government, by an entity. So like by a government. So governments make U.S. government gets U.S. dollar the way to pay taxes. This is a 1 out of 5. Very few entities require Bitcoin currently, or at least only Bitcoin. They don't require only Bitcoin. So, and then backed by power, again, this is 1 out of 5. Sanctioned nations might utilize Bitcoin. I think Iran currently is, but and central banks might someday use Bitcoin. But right now, I'd say 1 out of 5. And so here's the next one. I wanted to go a little bit deeper into Bitcoin as the scarcest money. So Bitcoin are mined every 10 minutes, and that's on average. That's not exactly every 10 minutes, but every 10 minutes on average. Every 210,000 blocks, every 10 minutes there's a block released. Every 210,000 blocks, the reward is halved. So in the beginning, there were 50 Bitcoin awarded per block. Now it's 6.25. And 18.7 million of the 21 million have been mined already. So you can see on the right here, annual current inflation is currently around 1.79%. That's about almost the same as gold, or a little bit less than gold, I think. Gold is about 2%. And after the next halving is what they call that, the issuance schedule will be less than half of gold, 0.83%, 0.83, 0.82, 0.81. So it's going lower and lower. It's actually you might not expect this, but it's going to be done in 2140, I guess, because it just goes down, and when it goes down so much, even though it looks like it went into 20 years from now, it's going to end 120 years from now. So that's that, and one more. Okay, so here's one I just threw in for fun, really. It's about modern portfolio theory and Bitcoin. Modern portfolio theory assembles portfolios of various assets so expected return is maximized for a given level of risk. So let's look at this portfolio of large cap stocks, non-US developed market stocks, emerging market stocks, bonds, and gold, 20% each. And over the period of which Bitcoin existed, that received a 4.13% return and 2.65% standard deviation. Now, here's the modern portfolio theory changing that up a little bit. Move 0.4% from each into Bitcoin, to 2%, and add 2% from each into 3-month treasury bills. So that's 10% total. The return jumps up to 7.01% return, which is big when you compound it over time. And the standard deviation actually goes down 2.63%. It goes down to 2.63%, down 0.02 percentage points. So it actually goes down, which is the holy grail of MPT, to go up in return and down in standard deviation. And the last one is just past performance. It's not indicative. It's it's not a predictive per se of future performance, but here's the past performance of Bitcoin relative to other assets. The left-hand column is the ETF that we're using. This is the description of the ETF. And then here's the returns from 2011 to 2020, 12, 11, 20. So we didn't catch the beginning of 2021 with this chart, this table. And in the last two columns, you can see the 2011 to 2020 cumulative return for Bitcoin is 6.2 million%, and the annualized 203.5%. The next best was the Nasdaq with this tech age at 512% cumulative and 20% annualized. So Bitcoin's done pretty well. And I look at my clock, I do have no more time really. So that's all I have, and I'm done. Thank you.
Okay, thank you very much, John. That was pretty interesting, but doesn't tell me if I should buy Bitcoin or not. So I'll stay on the sidelines for now. Next is the two stock studies. We have FAF, which is First American Financial Corporation, which is, I think, an insurance company, and FNF, which is Fidelity National Financial, and those two will be challenging Schwab. So I'll pass it over to Joanne and the stock study team.
Who will present first? Ally or Megumi?
Isla goes for. Isla's going to do the introduction and the industry overview. So yeah.
Okay. Isla.
Is she muted? Ella,
Yes.
you need to unmute yourself.
She's self-muted.
Oh, Isla, are you on your laptop or your desktop? One of her computers doesn't have the. Oh, she's trying to.
It looks like she's using desktop.
Oh. Isla.
Oh, there you go. Okay.
Can you hear me now?
Oh yes,
Yes,
we can hear you
hear
now.
you.
Okay.
Okay, great. Okay, thank you. Sorry, I'm using a new headset on my desktop, so
Okay. Perfect.
not sure if it's going to work okay,
Okay.
but we'll try. Okay. So we're starting with I'm Isla, and with Megumi and Tom and Joanne, we are the April Stock Study Group. And this is the disclaimer that I believe was presented earlier. Everything is here for educational purposes only. This is our agenda. And we will be presenting, as I said, the two stock studies, FAF and FNF. And okay. So how did we end up with these studies? We did some screening through the SSG, through Value Line, and through Manifest Investing. Tom presented some stocks that we looked at. A couple of the stocks were in the home building, but we were told by Joanne that home building had been done a few months ago and the club had decided not to do that. So after all of the looking through all of them, they selected FAF as a medium-sized company to challenge Schwab, and FNS also as a challenge to Schwab. So both of these companies are in the insurance specialty industry. They mostly do, let me click, I'm sorry. They mostly participate in the title insurance industry, which is a $16.6 billion business. What is title insurance? Title insurance protects against faulty research and reporting of past real estate transactions. In order to buy a property, you have to try to find out if there are any liens or past mortgages or taxes or property line disputes. And the title company's purpose is to look through that, try to find that and clear it so that the person can buy the property. Once it's cleared, the transaction can go through. If it's found after the transaction goes through that there were some problems, then the person who currently owns it is the one who has to fix those problems. The insurance makes sure that the insurance company takes care of that money outlay and the owner doesn't have to pay anything. So title insurance is the type of insurance that is paid only once. It is paid at the time of closing, and it lasts until the next real estate property transaction. Title insurers must assemble, maintain, and update access to all real estate transactions, any transaction involving the property at all. And they can be in several different places, so it takes a lot to get all that together. The search for transactions makes that underwriting of the policy very capital intensive. Insurance is highly regulated, and it's regulated on a federal level, but also very highly regulated from state to state. The 4 largest companies in the title insurance business are umbrella companies with multiple subsidiaries. Each umbrella company offers ancillary services such as assistance with escrow accounts and closings. Most of the title companies are small and regional and privately owned, but the 4 large companies cover 85% of the market. As I said, they offer additional services, and growth for these companies is usually by merger and acquisition. They expand out of the region and they add services that they don't already offer. Is that me? I hope that's not me. Trends in the industry. Currently, title insurance is very paper intensive. There is a move to use more digital forms and have all of these forms on cloud platforms. They want to offer many more ancillary services, and they want to concentrate on their core businesses. Many of them own other businesses secondary to title, and some of them are getting rid of those other companies. The challenges to the title industry are interest rates, which when they start to go up, since the title industry is very closely related to home sales, when interest rates go up, home sales go down, so that's bad for title industry. Environmental events, because many of the companies in the title industry also offer property and casualty insurance. So environmental events such as the Texas freeze or the California wildfires mean that they have to end up paying a lot of claims, and that of course is bad for them. Moving to digital. When the move to digital is made, usually what happens is there's a lot of money and time spent on data security, because leaks can be very bad for any company. And there are lots of digital startups that are targeting different access points in the real estate transaction process. And so the Big Four and all of the other title companies are under a little pressure in that area. So now I'd like to show you that Morningstar follows 82 companies in the insurance specialty industry. You can see the names at the bottom. If you go over to the right, you can see where insurance is. There are 18 companies there, and you can see that the insurance part of the financials has more 4-star companies than almost any other industry there, and fewer 1 or 2-star industries. So it is considered a good industry to be in. So at this point, I would like to turn it over to Megumi.
Do I share my screen? Okay.
Yeah.
Can everybody see my screen?
Yes.
Thank you, Isla, and hello, everyone. This is Megumi, and I'll be presenting a stock study on Fidelity National Financial Incorporated, which trades on the New York Stock Exchange under the ticker symbol FNF. They're a large-size company, as defined by BetterInvesting, with annual revenues over $10 billion. They're the largest provider of title insurance and settlement services to the real estate and mortgage industries. Their family of over 40 brands issues more title insurance policies than any other title company in the US. They view having multiple brands as a competitive edge because it gives their clients a range of title companies to choose from. FNF offers title insurance for both the residential and commercial real estate markets, which provides them a diversified revenue stream. And this is important because it levels out the ups and downs of a cyclical industry that title falls under. They have 1,300 offices throughout US and Canada with 21,000 employees. And here's a list of select rankings. Most notably, that Fortune 500 places them as a top US company in the title insurance industry. FNF has 3 business segments in which they make their money and intend to grow. The first segment is title, which accounted for 87% of total 2020 revenue. This segment consists of title insurance, mortgage and real estate services, and real estate technology. Isla described what title insurance was. I must have paid that fee a dozen times over my lifetime, and I never really understood what I was paying for, but now I know. Mortgage and real estate services includes 1031 exchange, warranty, and mobile notary. And real estate technology includes closing, title, and escrow software, as well as a digital transaction management platform. The second segment, FGL Holdings, or FNG, initially established in 1959, was acquired by FNF in June 2020, so just last year, and offers annuities and life insurance products. This segment accounted for 11% of total revenue in 2020. And the remaining 2% of 2020 total revenue was from their corporate and other segment, which is described in their 10K as, and I'll quote, consists of the operations of the parent holding company, real estate technology subsidiaries, smaller non-title businesses, and certain unallocated corporate overhead expenses and eliminations of revenues and expenses between it and our title segment. It's a mouthful. There wasn't much in the way of forecast and guidance in the 10K, but I jotted down a couple of notes here. The Mortgage Bankers Association anticipates that home purchases will rise in 2020 and beyond, while refinances will decline over the same period, with the overall peak occurring this year in 2021. And even though management was pleased with their year-end results, they remain cautious of the pandemic's effects on the economy and emphasize the title industry's close ties to the level of real estate activity that includes sales, mortgage financing, and refinancing. And sales, mortgage financing, and refinancing in turn are dependent on mortgage interest rates, mortgage funding supply, housing inventory and home prices, supply and demand for commercial real estate, and the strength of the US economy. As far as risk factors, there remains the uncertainty of how the economy will ultimately fare with the pandemic and what government policies will be implemented. There's also industry-specific regulatory environment that can change. Of course, every business has competition. And because almost all of FNF's services and products are offered in the US and Canada, the lack of geographic diversity can also be seen as a risk. And this slide is intended to show my revenue projection. As you can see here, there were no analyst forecasts shown in the SSG. So my 5% for projection took into account the 10-year historical growth rate of 4.7%, the sales growth trend increasing over the last 5 years, and Value Line's 5.5 projection over their time frame. Yahoo and Zacks provide a single year negative revenue projection, so I noted that. But that's how I got to my 5%. And here's my EPS projection. Again, no analyst estimates provided in the SSG. The 10-year historical growth is 10.1% with a steadily increasing or climbing EPS growth trend, though it did take a dip last year. And Value Line's projection over this time frame is 9%, and my projection was 5. My projection is the preferred procedure calculation of 5.2. And how did management do? Both pre-tax profit on sales and return on equity are trending upwards, which is good. The upward trend in debt to capital was due to the acquisition of F&G. So onward to forecast high and low prices. To get my forecast high price of $96.90 in the next 5 years, I used a 5-year average high PE of 14.8. To get the 5-year low price of $31, I took 30% of the $44.15 closing price on April 12th. Value Line's projected high and low price are within a narrower range than mine, but their time frame is also narrower. I also felt given the low price of $23.58 this year was a reason to go a bit more conservative than our typical low price, where we take 20% below current price. With these projections, the upside downside ratio is 4.0 to 1, which is a buy, up to a price of $47.50, and I believe today it closed at $44.77. And my recommendation for the club is also a buy based on these 5 points. First, with the projections that I just reviewed, the annualized rate of return is 15.8% using average PE and 19.9% using high PE with a yield of 3.5 and 2.9% respectively. This lower 15.8 figure meets our club's goal of doubling our money within 5 years. Second, Value Line, Yahoo, Zacks, CNN, MarketWatch, NASDAQ recommended a buy with the only recommended hold by Morningstar. Third, the general economic forecast is that home buying and refinance will continue through the next few years due to government monetary policy. The low supply of housing will also result in home purchases, and there is an anticipated rebound of commercial construction. Fourth, the industry's transition from paper to digital that Ayla talked about has already been proven to work during times when meeting face-to-face wasn't possible. So that obstacle has pretty much been overcome. And finally, fifth, our aging population, and particularly the underserved middle-income America, means an increase in demand for annuities and life insurance products. That's it. And Ayla will present on FAF.
Okay, how do I get the screen back?
I'm not sure.
I'll give it to Ayla.
Okay.
Hold on a second. I'll make Ayla the presenter.
Okay, can you see my screen?
Yes.
Okay, great. So I'm presenting First American Financial Corporation. It operates in 3 segments. Number 1 is title and services segment. And The title and services segment provides title searches. They write title insurance. The second segment is specialty insurance segment. They offer property and casualty insurance and home warranty insurance. And the third segment is the corporate segment. The corporate segment provides financing and support services for the other segments. So the corporate financing part, it consists of what is called warehouse lending. Warehouse lending is a loan given to a mortgage banker as a line of credit to fund a customer's mortgage. This loan is repaid after the mortgage is sold on the secondary mortgage market. These loans are typically very short and are monitored very, very closely, and FAS is a significant warehouse lender to mortgage bankers. Trends with First American Financial. They are, again, paper intensive and slowly moving to digital. They're trying to market to higher net worth clients. They want to involve themselves in wealth management also. Their challenges are higher interest rates, which would slow down home buying, more severe environmental events, which we talked about earlier, data security, worrying about leaks and breaches, and legislation on a lack of price transparency and conflict of interest between some of the sellers of title insurance. First American Financial's growth strategy, they want to digitize their business, as we've talked about before, which will lead to faster completion of the closing process. They are still looking for mergers and acquisitions in the future. They are focusing on strengthening their relationships with mortgage brokers, independent insurance agents, and other market investors. Their focus on services is actually, they made a acquisition last year of DocuTech. DocuTech is a company that provides digital documents for closings, all kinds of documents. They also provide notarization, etc. And DocuTech allows them to solidify some of their relationships with mortgage brokers. They also made a purchase of ServiceMac, which offers mortgage solutions to lenders and to other investors. They have, as part of their business, the First American Data Tree, which is what is called a data plan. This is what they use when they are doing a title search. This is the information that they are searching. And they must have access to all of the county records in pretty much any county in which they operate. It is considered one of the biggest and one of the best data plans in the business. They also offer trust services, wealth management, and they have a federally supervised savings bank. And they offer a service called FlexClose. FlexClose brings together their trust services, their banking services, and their title services together in one place so that all of these entities can work together for the closing. Recently, they've only offered it in Seattle over the last several years. And as of December of 2019, they had closed, that FlexClose by itself had closed over $1 billion in transactions. They are looking to expand this service to other areas of the country. First American Financial's revenue breakdown, their premiums, their insurance premiums and fees account for 81%. In information services, that data plank that they have, they use themselves, and they also allow other people access to it, and their investments account for less than 5%. Their segments, title insurance alone is 92% of their revenue. Their specialty insurance, the property and casualty, is 7.5% of revenue, and corporate is less than 1%. They have entered into they were initially trying last year to sell the property and casualty insurance, but in the process of that, they decided that it would be better to simply hand off their property and casualty insurance policies. So they will be transferring those policies to 2 other companies that handle property and casualty insurance. And as of about the third quarter of 2022, they will no longer be even supervising any property and casualty insurance policies. Right now, they're not writing any new ones. They're simply supervising the ones that they have. This is what the visual analysis on the SSG looks like. You can see that it is slow growth, but it is very steady growth. The pre-tax profit at 10.9% and return on equity at 13.5. We're trending up until 2020, but even though they were in 2020, they were less than they were in 2019, they were still above the 5-year average. The 5-year debt to capital averaged 21% over 5 years. It went up to 27% in 2020. So my sales forecast was 5%, and I chose that primarily because Value Line offered 5% as their estimate. And as Megumi said, with this company also, there were no BI ACE estimates for sales or EPS. So to be slightly more conservative than Value Line, I chose 5%, and I used the preferred procedure and came with 5.2%. I think that sounds familiar. As you can see with the PEs are very reasonable. They are definitely not overvalued. I chose the high average PE and came up with a high price of $104 and the low price of $51.90. Today's price, let me check that. I think today's price was $61.51. Yes, $61.51. So they are still in the buy zone. And I checked it earlier. I think the upside downside may be 5.5 to 1 now. The compound annual return using the high PE would be 14.7%, which almost matches the 15% guidelines. And the average forecast using the compound annual return on the average forecast would be 10.9%, slightly below, but still good. They do pay a dividend, and they're very proud of the dividend. Their dividend has been continuous for many years, and their dividend is quarterly. Last year, they raised their dividend twice, 5% each time. My recommendation is that FAS is a small, quiet, undervalued, consistently growing company. It will support your portfolio, and it should be considered for a buy. That is it. Any questions?
Thank you very much, Megumi and Isla. Those were excellent presentations, very well researched and thought out. Anyone have any questions?
Can we see the comparison guide? I think you have a comparison with Schwab and FAF, FANF.
Megumi has that, I believe.
I have a question as well, Adam. When you're talking about the title insurance, and obviously they're operating in both markets, the residential and commercial,
Yes.
is there some perspective, what's the percentage? Because I suspect with the COVID pandemic situation, the commercial side will probably not grow as well, with many offices kind of being closed, decommissioned, as people will tend to work from home more, I guess. So residential, I'm sure it's going to be pretty hard going forward. I'm curious how that ratio kind of maybe impacts the revenue.
I couldn't find a ratio. I probably could if I dug into a little bit more, but you're absolutely right. And that's why they stress that you really need to have both commercial and residential to balance each other out, because although commercial real estate tends to be driven by supply and demand for commercial space and occupancy rates in a particular area rather than by interest rate fluctuations. And then also interest rate fluctuations like the residential side, but also the residential market is typically strongest in second and third quarters. So timing is also an advantage if you're just diversified, because commercial sector generally tends to do well in the fourth quarter because they're trying to close out all their transactions by year's end. And it's the best I can do to answer your question right now.
That's fair. Thank you.
Can you make this a little bit larger? So we can read it? Be a little larger? Oh,
At the bottom,
maybe
there's
here.
I also noticed that both companies' sales are very low in the 5% range in the last 5 years, and earnings are in double, like 20%. Was it 15 or 20? I can't remember. But I
Oh,
was wondering,
thank you, thank you, thank you.
the margins at the 13%, is that, I don't know if 13% for this industry margin is considered high, because I noticed that the sales was very low for both companies, but earnings were quite high.
But margins.
Well, the margins are affected a lot by the capital intensity that they use to write the title insurance. They have to, as I said, they have to
Margin.
bring all of these, all of this information together, and they have to search it diligently before they can write the title insurance. So a lot of their margins are pressured by that.
That, yeah, so which company am I looking at? I'm looking at FAF. The last 5 years growth is only, sales growth is 3.5, but the earnings is like 20, almost 29%. The margin is about 15. FAF, the last 5 years growth is about 6% and earnings are 21%. The margin is about 13. So I'm just wondering if this is high margin company, and I just noticed that they have a pattern. Both of the pattern have low sales but high earnings.
I would imagine once they have the data about the, liens and other things, to do another search is not a very costly thing. So that's why probably they can charge well and have good margin on this, what they charge.
And the industry average is 5% for the sales or 10-year, and then 14 for 5-year earnings, or 11% for 10-year earnings.
That's the industry? Okay.
Yeah, it's industry, yeah.
So these two companies performed above the average, industry average, the last 5 years.
Yeah, with the earnings, yeah.
Yeah. There was a question from a guest who was asking, why choose premium income over investment income from Value Line for the estimate comparison?
Wait, what was that question? Say that again.
Why choose premium income over investment income from Value Line?
Because
for
the premium income is a larger percent of their revenue. It's the bulk of their revenue. It's, what is it, like 90%?
For FAF, it's like 92%. I believe it was similar for FNF. Yeah.
Yeah.
So the premium do provide the bulk of their revenue. There, I know for FAF, the investment is less than 5%.
FNF, the percentages were the same, like 5.5 for both.
From what I can see, it seems like Schwab is the winner here.
Well,
Schwab winning for sales growth, and just
Schwab is
on the top.
Hold. Oh,
Can
but
you
look
just
at
go
their,
up the beginning?
okay.
I know, just for the comparison with a highlight. So Schwab was winning on the sales growth, and let's see.
On the estimated sales growth too.
Estimated, and R square.
And estimated earnings growth.
R square, 10-year R square, it doesn't look good for the other two, for the new companies. But for the 5 years, that's amazingly 0.9, 0.93. That's R squares. I don't understand. Totally like a reverse sort of.
Does Schwab sell insurance?
I was going to say, is it fair comparison?
No.
Like this is different.
No, I don't think so.
So I'm not sure how valid this comparison.
Yeah. Well, this is straight. Just compare your SSG. Based on your SSG input, that's what the outcome is. I don't think, in terms of an industry, I don't think it's direct comparison.
Yeah. And one of the reasons why we're challenging Schwab is because the return was
Was much lower.
It was much lower. Let's see where is it?
Mm-hmm.
Yeah, here we go. Return right here.
5%. Yes.
Yeah.
Mm-hmm. Okay.
Yeah, the average was going to be less than 1%.
I think it's fair challenge. We just don't need to compare it in that way, right? Like
Mhm.
we're proposing two new candidates in itself, but
I mean, we can also hang on to Schwab and buy one or the other. You know, we have so much cash, but
Right.
if it's a good time to sell
preference
Schwab, we can sell Schwab.
between the two, or it seems like they're one of the two largest in the space.
Yes, for title insurance.
Is there like a preference? Which one?
Not really.
Not
Tom
really.
was mentioned during the treasury report. He was saying Schwab was the winner. Was this month on Tom, if you remember, Tom Jones? Something you mentioned about Schwab was doing well.
Well, historical return, Schwab has, of the stocks we hold now, Schwab has the biggest gain because we bought it low. But, you know, it has gone up quite a bit. So I think, you know, to me, that's the concern, you know, like we're trying to invest for the future. We're not looking back and seeing how much money we made in the past. So you look at these compound annual returns on these, and they're double digits on the two companies presented today, and Schwab, they're less than 5%. So, you know, if we go by, you know, future projections, we expect the return to be better on these than on Schwab. But, you know, they're definitely different types of financial companies. They're not really comparable at all, but they are in the financial services sector.
Yeah, and the objective, I think, is to bring the portfolio average up. So you know, it was about 6%, I think, last month. We've got it up to about 8%, and our objective is to bring it up to about 15%. So we have a ways to go. So the way to do that is to look at companies that have had a pretty good run, that are not going to return very much in the future, and replace those with you know, faster growing companies. So I think this makes a lot of sense.
Yep.
And does our portfolio take into account, like, do we get 0 for cash, or is that just not counted?
Yeah, we don't. Yeah, we get 0 for cash. Yes.
Okay.
Yeah.
Okay.
Would interest rates increasing decrease the sales of both of these companies?
Yeah.
Yes.
Yes.
So
Definitely.
Which
one is in the
number
middle?
of housing units sold, right? That's driving their sales or refinance.
But both.
Yes, both.
Okay. But for Schwab, to be clear, increasing
which one
interest
has
rates would increase their sales. Is that true or false? Does anyone know?
Typically for finance, the higher interest, the better.
For Schwab, right?
Yeah.
So we're really betting on what we think interest rates are going to do over the next 5 years.
Right.
Okay. And they're at all-time lows right now.
Yes.
They may go even negative, right?
I wish. I'll refinance again.
Yeah. Okay.
But
those are my questions.
So which one of these is in the middle? The 19.9% annual return.
Fidelity.
15.8%
That's FNF.
Fidelity.
FNF.
Okay.
Can someone close that? Okay, thank you.
Sorry.
Can we scroll up? Like,
Yeah, can you go scroll up?
Okay.
All right.
Earnings. You give projection earnings 28. Oh wait, sorry, that's historical. Never mind. You give earnings
5.2.
5. Okay. Oh, the projections are exactly the same for both companies. 5.2.
Oh.
Yeah, they are.
You You use the preferred procedure? How come? How much is the same?
I did, yeah, I used the preferred procedure, yes.
I also used it, but earnings was a negative for me.
Well, one of the things that I did was I increased the pre-tax margin a little bit because what the default was very low, was lower than what it has been over the last several years. So I increased the pre-tax margin some, which is how I got to 5.2%.
I had a negative 2, Jay, but it's because the fields weren't filled out. So I had to manually input all the fields in the preferred procedure box, and then it bumped it up.
Okay, I think we should probably move on because we still have a few other things to get through here. If there are no more burning questions. Anyone? No?
No.
Okay. All right. So next we have 2 annual reports. Adam is going to be presenting Franco-Nevada, and I'll be doing Kirkland Lake.
Adam first.
Sure.
I'll make Adam presenter.
Okay. Can you see my screen?
Yes.
Yes.
All right. So Franco-Nevada, it's I guess gold-based company. They actually don't necessarily own any mines or things like that. They get the revenue from the streams that they purchase from various mine companies.
Can you make it larger?
Sure, let me.
So Adam, sorry, just to correct one thing. So they're streaming companies, which means that they actually own the resource, and then they lease it out to the mining companies.
There,
right.
Thank you.
For that,
thank you.
For that,
Thank
they
you.
get for that they get a fee, or they can get preferential gold pricing. There's different mechanisms.
Yeah, and in a sense, they look at the revenue from a gold equivalent kind of ounce perspective instead of directly. So let's look. This is the annual kind of thing. The year end was the end of December. I took over this review from someone previously. So at the time we purchased this at 142, which I guess was a high price at that point. Closing when I was doing this review was 129. Today is 136.79. So price kind of rebounded a bit from the time I did the study. It went as low as 99, as high as 166. This is all US. Current P ratio around 47. As you see, average is about 61. So we see the current is actually below the average, which is kind of maybe good entry point. Then you have the average low and high. And what happened over the last year, actually 2020, it turned out to be a strong year, surprisingly, even though the COVID interruption was there, and one of the mines had a strike in the Candelaria mine. They had strike, but by year end, kind of things settle, and everything kind of rebounded. So in a sense, they had a year that kind of brought over 20% kind of growth. And this was the year where they actually first time reached the 1 billion kind of revenue in their business. So huge and strong performance. They did increase dividends. So it's a company that has a dividend as well. And they increased it to 30 cents, which is for them practically the 14 years that they're successively increasing the dividends. So pretty good for stakeholders. Asset management, they're still growing. And as you see, the big one is the cash flow. They have about 800 million per year cash from operations. So doing well and no debt, and practically about 1.9 billion of available capital for investments. So strong year, good projection going forward. So let me touch on those historical and the projection things. So 10-year sales growth about 10%, 5-year even higher. Last quarter obviously was very strong. The trailing quarter even stronger. The previous kind of sales forecast was about 7%. I'm raising it to 9.5, and I will show you the judgment just shortly. Similarly, the previous estimate for earnings per share was 7. I'm keeping it at the same. As far as judgment, so I look at consensus, whatever analyst consensus value line, and given this was year end, so there was a management 10K or F in this case. We have about value line was 7.5. Most of the other analysts were around 7 to 9%. As far as the management consensus from the company itself, I look at the forecast of how many gold equivalent ounces they project to produce, and this can be seen right here. So the guidance was that for next year itself, they foresee that they will grow about 10 to 15%, and this gold equivalent ounces projection is about 555 to 585 million to be there. And this will be kind of based on additional outcome from the Cobre Panama mine, Antamina mine, Condestable mine, and some slower deliveries from the other mines that they have. Part of the revenue, and I would say 91% of the revenue comes from the gold and mineral type of things. About 9% comes from energy revenue, where they still have oil and gas kind of related income. So projection for the energy revenue is about 135 million for next year. As far as 5-year growth, they're even seeing a larger kind of performance. So management projects about 20% growth from now on. And interestingly enough, the projection during the annual call and through 10K listed this number where they're gonna grow to 630 million thousands of the ounces, the gold equivalent ounces. Today, actually, they had an announcement like latest news, and they revised that projection even higher. So it went from originally kind of thought to be going to 630, they're gonna go now to 660. And this was due to the new acquisition they made and announced. And the acquisition was in Brazil, where they got some from Brazilian Development Bank and government of Brazil, the outstanding participate debenture in the Vale Northern and Southeastern iron ore systems. It's practically gold, copper minerals that they're gonna get out of it, and they foresee that this is gonna yield like 8% investment going forward. So that helps them revise the kind of forecast of even higher than they had before, which it's kind of, I guess, making my case even stronger for the estimates they provided. So let me go quickly to, so the revenue I forecasted to be 9.5, average came to 9.7, I put 9.5 for, and this kind of aligns with, it may be a bit higher than the value line kind of came to revenue, but it aligns with their projection, as well as kind of there is optimism that the revenue from the energy sector is coming back as the oil prices, gas prices are kind of finally rebounded in the fourth quarter and now kind of are keeping steady. There was a good question because Hani was reviewing this for me. One is to see how do we kind of look at this from a perspective of sensitivity to the gold price. And another one was related to, there was a revenue from the energy sector last year was much lower than prior year. So prior 2019, they had 160 million. In 2020, only 92. But this was kind of aligned with their revised projection for 2020, where they kind of forecasted that they would only generate around 95 millions. And in reality, the Q4 kind of brought the oil prices back, and they were back to 92. So kind of, or actually, the projection is 75. They came with around 80 to 95, and actual came to 92. So it rebounded because the price they used was $45 per barrel, and now the price is about 55. So actually, the energy sector is doing better than they anticipated at the end. So the other aspect is the sensitivity to the gold price. So I kind of look at their projections and quickly had to update it based on the new numbers, 630 and 660, the kind of lower and upper end. So this kind of projects if they hit the lower end or they hit the higher end production. And then the gold price, the one that they use in their forecast, 5-year forecast, was 1750 per ounce. Today, gold price is 1771, as you can see. So it's already better than what they use as a forecast. And I kind of took it as, okay, if the gold price would go 20% up, what would this look like for the revenue? So it would go, instead of 19% up in 5 years, 43% up. Worst case, if it goes down 20% from their projected, they would have a practically no revenue increase over the 5 years. So there is projection, you have to take into account that how the gold price will perform down the road. This kind of touches on that, though. So there's tons of acquisition they make to kind of substantiate the revenue growth. The other thing I wanted to show you is the, I guess, comparison of how does it look from a projection of average and current PE. Let me increase that view for you, if I can. Does it grow? Not really. How do I get it bigger? Oh, here. Sorry. Let me zoom in. So as you see, this is a 5-year kind of chart of the price and the price earnings ratio. Average price earning ratio is about 60. So that's the dotted line here. The high is 67, the low is 55, and current PE ratio is around 47. So in a sense, it's below the average. So typically, this is, as we kind of call it, like a potential entry buy point from just that kind of analysis, where you would rather buy it when it's low and sell when it's high. Given we bought this way back, I guess we did not perform as well because we bought it at a much higher price than it's performing now. But I think with the price it is now, actually we can buy and kind of make up what we kind of couldn't make over the last few years. So in a sense, the performance wasn't there, but I think there is opportunity now to practically buy into it at this price point and kind of bring it. So let me quickly show you on the SSG. As you see, still kind of steady trend. As you can see, here are my kind of projections, and this brings you to about 4.7 downsides, which about 15% average annual rate that you gain from it. The range to buy is about under 140, and as you saw, we are about 137 today. So we're still kind of within the buy range. So that's the recommendation for today, reviewing that stock. Any questions?
I'm sorry, Alan, can you show me the earnings projection again?
Let me just go to the,
First page.
yeah.
So why you give so low earnings? The last 5 years is also doing tremendously well. Just look at the actual front data.
So I look at all those forecasts and projections from both the analysts and even value line. Really, there was no, it was really consistent kind of all across the, from, mind you, there are some of the 2 years, 5 years, but value line gave 3.5. The best I could find was 3.7 earnings per share. Which kind of corresponds to around 7%. So really nowhere in any analyst forecast I could push it that much higher.
Wait,
And
that's
if
a
I
sales
did
projection. I was
that's
talking about your
the
earnings.
No, that's the earning. If you're talking sales, it's, and I put it 9.5.
Oh, when you just show me the analysts, I thought I saw it was saying was earning the projection you were looking at. Are you looking at earnings forecast? Sales growth? Oh, are these earnings you say?
Oh,
Okay.
sorry. This is, I don't know. I think that's a template error. Yeah, this is earnings.
Okay, that's earnings.
Yeah, I guess, I don't know. The template had probably duplication of the table. So yeah, this was the earnings.
Okay.
So that's, yeah, I couldn't substantiate better. I tried to look at the preferred procedure. It brought it even lower. So if you go with preferred procedure, even if I lower it to like 50% tax and keep everything consistent with the 9.5 sales revenue, it will bring it to the kind of hold, still kind of, it brings it to the hold level, not totally buy, but close to the buy. It's like borderline between hold and buy.
I'm just wondering if our projections are too conservative.
If you look, the 5 years comes up to 3.83, right? 3.86. Value line pushes it up to 3.5. So it's still, but I project more than value line itself.
No, in the past, it seems like it did better in the earnings than 3 or 4%, but okay. In the past, I mean, the curve looks like it's going up faster than that.
So growth percent wise, but if you look at the earnings itself, right?
But it's still coming up
Yeah,
as a buy. It's still coming up as a buy despite the conservative estimate.
Right.
So if it does better, great.
I know, but it is buy because the PE gave 65. Well, you can give a bit optimistic earnings projection, lower your PE.
Oh, so I took out the kind of outliers from PE high, right? Over 100, kept it to whatever was closer to 60s, kind of 60, 70 range. So I don't think the high PE is that far off.
Why did you take out the low PE for 2019 and 2020 if they're trending down?
Again, to kind of keep it to a more consistent kind of ratio that they had over previous years.
What was your low price? 151? Or you use a projected low price? I can't
put
remember.
the 20% down to low price.
Current price.
Yeah.
Okay.
Current price down 20%.
Okay.
Peter, should we move on so that we have time for Hanny?
Sure. Want to
Okay.
hear the competitor?
Yeah.
Or not.
Or
Yeah,
not.
I want to hear you.
Okay.
Hanny, you're the expert. You're the mining expert.
So, Henny, are these two companies direct competitors?
No.
No.
No. One is a streaming royalty company, and the other is an actual gold miner.
Which KL is the miner, right?
KL is the miner, Kirkland Lake.
Okay.
Yeah. The only other thing I had, that they have really good geographic diversity, and Yeah, it seems like a very consistent growth. Yeah, depending on the gold price, but over the years, very persistent growth, very good operating margin. Like they don't increase the operating costs, as you can tell. G&E is actually going down, and pretty good projections based on how the
Adam,
yeah.
Adam, can you go back to SSG and can you refresh for your current price? Because I'm seeing your price being 129, but as of yesterday it was already after the market is 138.
Okay, 137. Okay.
Yeah. So if you and then you
Yeah,
look
so
at your
it came up to closer to that, buying range.
yeah, and
So
if you look at your high PE, you use 65. Can you lower it down to 60?
Sure, if it helps.
Yeah, see how it goes. Yeah, I just want to make these two adjustments because if you look at the current PE, high PE for 2020 is 60.4. So I will be using 60 instead.
Yeah, I would too, but I will boost the earnings actually. I will make the earnings a bit higher. You align earnings with the analyst projection that was was $3 something. It was why mine is only like $2 something. Weird. I just
Adam, I would lower the low P ratio also.
Yeah.
Low P, he used 20% of a current price, I think. Right?
No.
For low price, but
yeah.
He did not use the low PE.
But Adam, the most current events are the ones that are likely to continue. And
yes.
for the low PE, you have 37.26. Those are the most current. Why do you all of a sudden jump up to 55?
Yeah,
You should continue kind of low.
Okay, let me see what.
I don't think he used it. He didn't say he used the calculated price.
No, but he used 55. But the trend for the low PEs are down.
Oh yeah,
they're down
I know.
below 55.
Yes.
But put it back up. Why?
Try to use it. Yeah, try to use it.
Oh, try to use the low PE. They were saying, okay.
Yeah. Or even use it a little bit lower.
Better.
No, use it lower because it's 28 for the current year, right?
So
28?
let's say I put 45 now, right? And
28. Can you put 28 instead?
Where's 28? The lowest ever is 37, Jane.
2020. 2020 is 28 for low
2020 is a 45. You must be looking at the wrong screen.
No, it's 28. 28.
Oh, sorry. Wait, what? Frank Nevada. Yeah,
28.1.
Yeah, I usually use the current year's PE for the low and high.
Hold a second. Why mine shows a 45 low PE for Frank Nevada? That's weird.
Are you looking at the Canadian version or American?
I don't know.
Yeah, that's a good point. If you scroll up a little bit, Adam, that's
I'm
the
using
US.
the US. Yeah,
that's the
Nasdaq.
US. Yeah.
Mine is so weird. Mine looking 45.
Yes.
Generally,
can you make it larger?
Yes, generally BIs are just used towards when the PE ratios are stabilizing.
Yeah.
Use the recent ones are most likely to the recent ones than.
Yeah.
So even your high PE should be a little bit lower, say 55.
Yeah, the high PE should be around 55. Low PE should be around 25.
Oh wow!
Yeah.
Thank you.
Yeah.
Thank you. So Yahoo says that the PE is 80 this year, and next year it'll be 40, which indicates that the earnings were going to go up from the PE to go down from 80 to 40. The earnings are expected to go up, according to Yahoo Finance.
What's the price going to do?
Well,
we don't know.
You know, a lot of this is going to depend on the price of gold. But the company is a very well-run company, very high-quality assets, and very well diversified. So, you know, but if the price of gold tanks, then it doesn't matter. Like you're gonna, you know, it'll be beyond their control. They don't actually produce anything. They only hold these properties and then lease them out or have some sort of arrangement with the miners. So they don't have the production risk that the mining companies do. And so their operating costs are considerably more stable and lower than the mining companies. So really this whole discussion about PE will, you know, I think it'll have a lot to do with what the price of gold does.
Yeah.
And the reason that we would hold one of these companies is more of a hedge against inflation.
Inflation.
Yeah.
But
instead of actual gold, yeah.
Yeah. No, Haney, one of the things I hear about gold and the American dollar is that they are on opposite sides of the teeter-totter. When the dollar goes up, gold goes down. So it's a question of the American dollar. Is it going up or down?
It's gone down quite a bit in the past.
So it's bound to go up, meaning gold's going to go down.
Oh, I see.
No, I think the U.S. dollar will keep going down.
You think?
But, yeah, because of well, I think, just my personal opinion, I don't, but a lot of, I think in Canada, the US, the UK, with all of the stimulus that's going on, you know, where I think a lot of governments are counting on inflation to pay back all that debt.
Yeah, but when I hear, you know, worker productivity, the Americans always come out on top. They have the most productive workers. Canada's a way laggard. So if the American economy roars ahead, they're going to be producing the most, and the dollar will go up.
Yeah, possibly. I don't know. I mean, there's arguments to both sides, but when you're printing this much money, it's at some point, you know, you have to pay the piper.
Yeah, the interest rates will go up.
Yeah.
Yeah, and the higher the interest rates, the better the American dollar.
Someone's asking, is gold still the opposite of a real estate?
What happened?
Is gold still the opposite of a real estate? If real estate goes up, gold goes down. Is that true?
Real estate goes up.
I'm not sure the two are correlated.
Yeah, I have a hard time correlating.
Okay.
It's maybe if you look at the interest rates and things like that, maybe you could say that if interest is low, gold goes up and so on.
Yeah.
Okay. I'll move on.
All right.
And I'll make myself presenter. So I'll be presenting Kirkland Lake Gold annual report. And Kirkland Lake is a gold miner. They have 4 locations, 2 in Ontario, 3 in Ontario, but 1 is closed, and I'll talk about that. Yes, Bernard. You'd like me to make it bigger?
Can you make it a little bit?
Yeah. Give me 1 second.
See it. I want to read it.
Sure. Okay. I hope is that better, Bernard? Can you see it okay?
A little bit.
Yeah. More?
I'll be all right. Okay. Yeah.
All right. Okay. So the Kirkland Lake is a gold mining company. They have operations in Ontario, Canada, and in Australia. And they did fairly well this year. We purchased the stock at $37.75. When I did this report, it was $37.26, so it was down. But today it's up to $37.79, so we've made 4 cents. The 52-week low is 31, so we're hovering kind of near the the low, and the 52-week high is $57. Current PE ratio is 12.9. 5-year average is 15.1. 5-year average low PE is 8.4, and the high is 21.7. So again, we're kind of near the average. The quarterly revenue for the year Q4 2020, which ended in December of 2020, revenue was up significantly from the previous by 44%, and the annual revenue was up 168%. I won't go into the current ratio, but the free cash flow has also increased. I am going to mute a few people here because somebody's in the background. Okay, and then from the SSG, I'll just show you that, and I picked a growth rate of about 6%, and then using preferred procedure, got an earnings growth of 2.4. And when I looked at PE, I used, I'm not sure why, 11.8. It should be a bit higher. I think I was going to use the average. I'm not sure why this one came, but I'll put 14.5. This doesn't make a whole lot of difference, and the I went about 20% for the low price, and it came out as to 1.3 to 1, about a 5% appreciation. But the main reason that I'm recommending that we sell this stock is, let me get my where's the I lost my report. Here it is. So I looked at management guidance, and if you look at page 14 of the management discussion and analysis, they're talking about, there's a couple of sort of strange things that happened. There's a mine called the Holt complex in Northern Ontario, which is actually 3 mines feeding one mill, the Holt mill, and that was producing quite a bit, about 20% of 2019 production. Then in, I think around January, they closed it because of COVID. And then shortly after that, a few months later, they said that they're undergoing a strategic review and it would be closed indefinitely. Now, they had just completed the purchase of another operation called Detour Gold, and their numbers for the year in 2020, they were going to be impacted by this Holt mine closure, but because of the acquisition of Detour, that brought the production levels up, and because of the price of gold was quite high during the year, that's why you see the net revenue had gone up significantly from the previous year. But this closing down of this Holt complex is a bit strange, because they claim COVID, but then they had COVID at their other locations, and they took certain precautions and so on. So I'm not really sure why they decided to close that and do a strategic review. The other troubling thing is that Kirkland Lake used to be a low-cost producer, one of the lowest, in fact, in North America, and their production costs have increased significantly. They also don't, other than this new acquisition of Detour, they're doing a lot of drilling because they don't have a pipeline of properties or exploration. So most of their exploration is focused on the properties that they currently own, and they're hoping to find gold in those areas. That's a sort of a long-term prospect, because even if you find it, it has to be at the right quality, the right concentrations, and then they have to be able to extract it efficiently. So there's a lot of ifs around their future production. So, and I'll show, well, we can do that right now, but I don't know if Bernard, if you can see this, it's a bit small, but if you look at Detour Gold, which was their recent acquisition, their 3-year production guidance is pretty much flat. It doesn't change at all. And then Macassa, which is in Northern Ontario, is the one that they're hoping will increase production, but not by a whole lot. And then Fosterville, which is in Australia, is increasing in 2021 and then starts to go down after that. So unless they can find some new discoveries, I think they're going to be pretty flat. I did the same thing as Adam. So I did a bit of a sensitivity analysis and using various sources of gold price predictions. And these are sort of, so in 2021, which I think this is a bit optimistic. I mean, some of these are quite high in the 2,000, 2,300 range. And then long term, some of these guys are projecting 4,500, 3,000, which again, I think is a little bit optimistic. So what I did was I took their management's production and both the low and the high number of ounces up to 2023, and then I took pretty optimistic gold prices. Like we got 1,400 2019, almost 1,800 2020, and then I shot up quite a bit. So not Adam was a bit more conservative in his estimates. I was a bit more aggressive, but you could see compound annual return and the average return per year is like about 10%. And and that's, this is 10.6 and this is almost 12. This is using the optimistic production numbers, and those are always kind of iffy because, like I said, you have to guess at the quality of the resource, and then the fact that you'll be able to produce it cost effectively, and that's not always achievable. So using kind of that growth figure and plugging that back in into the SSG, I got pretty slow growth sort of numbers. This is again Zacks, Value Line, Manifest, and so on. So the long-term EPS growth is, the average is 7.21, but you could see Value Line kind of skews that 15%. Everybody else is more conservative at less than half of that number. And sales, again, Value Line is projecting double-digit sales growth. Everybody else is projecting much more reasonable numbers. And then when you compare that with these numbers from management, I think this is Value Line is being pretty optimistic here. This is the 12-month price target from various sources. So around somewhere around 50 to 55 to 60 dollars. So doubling. That's the next 12 months from the current price. So going back to the SSG, not very sort of enticing returns. 5.4 using the high PE. So that's the main reason that I'm recommending a sell, is that we don't really have a lot of visibility on production going forward. Management is being pretty cautious, and there's not a lot of unless they do another acquisition, there doesn't appear to be a lot of potential new gold finds. Compare that with Franco-Nevada, where they have a huge diversification and all over the world, as Adam said, geographically and different regions. I think it's a much more sort of stable proposition going forward. So my recommendation would be, if we're going to be in gold, I would sell Kirkland and go to put the money towards Franco-Nevada.
I'm with you.
Very good, Haney.
Any questions? No questions? Okay. All right. So I think next on on the agenda is sorry, let me
Buy,
yeah, sorry.
buy and sell motion.
Buy and sell. Yeah. So
Yeah.
do we have any motions?
I have one question.
Yes.
Is a fundamental
I
investing
move.
club, should we be investing in gold at all?
Yes.
Sorry. Could you repeat
Yes.
that, Matt?
And diversification.
As a fundamental investing club, should we be investing in gold, given that the price of the stock has little to do with how well the company may or may not function?
Well, it's not entirely true. So if you have a company that is not that's not an efficient operator, regardless of what the price of gold is, they're not going to do well. So somebody that's a low cost producer, they're sort of dependent on the commodity price, and you're seeing that in oil and gas right now. But if you look at certain companies like Chevron and ExxonMobil and so on, they're still doing fairly well despite the fact that world oil prices are low. So to some extent, it's really beyond the control, the commodity price, obviously. But if you're an efficient operator and you can keep your costs down, you can still do okay. So the reason I would say we should hold gold is just, again, as a hedge against inflation. And you talk about, Matt, fundamental sort of investing. So Warren Buffett bought a large chunk of Barrick Gold recently, and he was opposed to, he never, I think that was the first time that Berkshire Hathaway invested in gold. So
yeah, he's already sold it too, and it was only like 300 million out of $500 billion.
Yep.
We only had this companies for half a year.
Yes.
I don't know. I'm just wondering if we sell too soon.
Well, I mean, if there's a
let's vote and find out.
Well, if there's a Jay, if there's a potential, if they had more, if they were able to find more gold, but if their production is going to remain flat, or if there's not a lot of opportunity, then it's not a bad idea to put to look at something that's a little bit more diversified. And Franco-Nevada is pretty diversified. If you look at their where their streaming royalties come from, they have like huge diversification. So I'm a bit more comfortable with that. But
right. So when we first purchased that two companies, what was the reason why we bought KL 6 months ago for both?
I don't know. I did the industry study. I didn't do KL.
I was wondering why we did not buy the best at that time if Franklin Nevada was.
They were, I think, I don't know, but they were doing fairly well at the time. I think recently when they closed this Holt mine without really giving a reason for it other than COVID, that was a bit of a red flag because all of their mines had COVID issues, and the problem with mining in particular is because it's in remote locations, so you're getting all these people that work at the mine. They quite often don't live there in the same community where the mine is, and they're being transported by small aircraft and bus and all sorts of, in close proximity to each other. I've been down a few mines in my lifetime, and a typical mining elevator takes about maybe 100 people on 2 levels, and you're packed like sardines, and then you have to change your clothes and in the close quarters, so there's a lot of opportunity to catch something, and so I'm not surprised that they had COVID, but they had it in all their mines. And why Holt in particular that they decided to close it long term, and they weren't clear on that in the MD&A, so that made me a bit nervous. But I think the main reason again is just the low forecast going forward. That's my reasoning anyways. I mean, we can vote on it, and so I'll make a motion for that one. Does anyone else want to make any other motions regarding the 2 stock studies that we had?
So I can.
Well, I want to make some motions
Nevada.
Well, shouldn't we dispense with one motion at a time?
Yes.
Rather than creating a whole bunch of them out there?
Right.
Okay.
So if I remember correctly, we make a motion right now, have a discussion, but voting can be done within 24-hour window, right? We don't have to vote right now. Is that correct?
Oh, gee.
Yes.
No, God damn. No. Oh, okay.
Yeah, well, we can put it in the system and you can vote right away, but we have 24 hours.
No, I don't know. I thought
I would like to make a motion.
Okay, I'll finish this one, Bernard, and then
I second Haney's motion.
Okay.
Matt, okay. And simple majority ending, keep voting till majority is reached. Let me put this up so people can see what I'm doing. 5 members when voting has ended. Save motion. Okay. All right.
What is the motion, Haney?
To sell Kirkland Lake.
And we have a guest who says Doug Gerlach. Let's see.
Yes, I'm aware that it's. I think it's in the investor advisory or the small cap informer. I'm not sure what they
base it on.
Yeah.
Okay.
I don't know if he's recommending selling, or I don't know what the recommendation
buying.
is.
He said it's a good investment. Yeah.
Okay.
In his webinar on Saturday. Okay, I'm curious what webinar was that? What was his reasoning? But look the graph, look the fundamentals. It looks pretty good to me.
Okay, so can I make a motion?
Sure.
Yes. Have we finished the discussion on this one? Anyone else have anything to say? Going once, twice?
Yeah, I would go. I think Haney's an expert. I would take his decision on this right to the bank. If he wants to sell this, I think he's probably knows what he's talking about. So I
Plus
would
we have
say
a
I'm going to vote
stock.
yes.
Well, I'm overly cautious, so maybe I'm wrong. I don't know, Bernard,
Yeah.
but
Okay.
that's my guess is, that's. I just got nervous when they're not projecting any sort of future expansion, and then they close this mine for no reason. That was a bit strange, but anyways, okay. You wanted to make a motion, Bernard?
Okay. Yes, I do. I move that we buy $2,000 worth of IIPR, Innovative Productions. This company have a profit margin of 56%, a operating profit margin of 59%, growing dividend 2 or 3%. This year's insiders are buying, and this year's PE is like 56, and next year's PE is 40, and the insiders are buying, and it's a small company in a growing industry. So I move we should buy it, and we got a lot of cash, and this would be a good way to deploy it for the future.
Okay.
It's a diversified marijuana play.
Yeah, we already own it, but you're saying buy more. I think
Yes.
we have to do an SSG in order to buy more. So we have to do a quick study on it. So we haven't done that, but I'm if you want to make the motion, I'm okay with that. So you said buy $2,000. Jay,
What's the price, Bernard?
Yes, we have done SSGs on that several times, I think. I know I have.
Yeah, just that we did.
If you want me to do an SSG, I'll be.
So who is the follower?
glad
Maybe
to
we
do
could
it,
get their
sure.
opinion on that.
I think Joanne's.
I think Amy's a follower.
No, I was, and then I handed it over to somebody else.
Let me take a look. Who's following IPR? Reddy follows IPR. Joanne
And I
is a peer
think,
reviewer.
and I think he's giving it next quarter is the quarterly update.
Can we wait till next month?
I think we should.
Yeah.
Okay.
Okay.
But Bernard made a motion, so I think we can vote on that.
Somebody
But somebody had to second it, right?
If it doesn't second, the motion dies.
Yeah, that's
Okay.
right.
That's true. All right, Bernard, we'll have to wait till next month, I guess. Unless someone wants.
Okay, and I'd like to make another motion.
Okay.
I'd like to make another motion.
Sure.
Okay.
This one, I would like to move that we buy $1,000 worth of QLYS, Qualsys. And the reason, there's several reasons. The profit margins 25%, operating margins 26%, insiders buying, heavy insider ownership, about 7%, and they're buying. And the trailing PE is 46, but next year's PE should be 39, so the earnings are expected to grow. I know the price has gone down a little bit, but this is a small stock in a very important industry, the security industry, and I think it's a good buy for our club. And I move that we buy $1,000.
Okay. We also own it.
We also need the SSG. We also need to do the SSG.
I don't know if they found a new CEO for Qualys. The price got dropped because the CEO left due to health reason. I'm curious about that company too. But now, can we wait until next report so we can take a look in depth?
Or Bernard can do
I don't
the
mind. I
SSG
think
and
he's
present, right? Bernard can do a SSG next meeting and present it as a purchase idea.
I'd be glad to. I'd be glad to.
Yeah.
Okay.
Why
I'd
don't
be
you do
glad
that?
to.
And if you want to talk to
Okay.
Reddy about IRPR as well, then the two of
Yeah.
you can maybe come forward
Exactly.
with some.
That'd be a
Okay.
pleasure. That'd be a pleasure.
I think.
Okay, fine. Thank you, Haney. Thank you.
Okay.
I will move. I will move to buy. I don't know, it's 1,000 or 2,000 of FAF.
Sorry, which one? FA as in Apple?
FAF. Yeah, as Apple.
We
Okay.
have lots of money.
Yeah, it's up to you.
Why only 1,000?
2,000.
Yeah, just
I
buy
don't know.
more.
Okay.
FAF, is that
What?
the one?
What's that
Megumi
you
presented
want to
on the-
buy? Oh,
Jane, why do you like that one
I thought
better
it was
than the
FNF.
Sorry, one.
Price-wise,
Oh, FAF.
it has not shot up as much as FNF, and it's apparently, I think FNF has a lot more exposure in the media, so that's why the
FAF.
price shot up. The price shot as you know, as much as it has. So I think FAF, in terms of the quality of the company, in terms of the pricing, the valuation, I think it's better than FNF.
Jane, how much did you? How much?
2,000.
2,000. Okay.
Yes.
Hey, Megumi, can I look through your screen one more time on the, because I don't remember which.
Yeah,
which,
I'd like
on
to see
the
that again.
comparison.
SSG?
The
Or-
comparison.
Yeah, the comparison.
Somebody else had that up.
Stock comparison guy.
Oh, who had it? Was Joanne?
Yeah.
Was that you? Oh, you had. Okay, make yourself presenter. Where's Joanne? I'll find Joanne. Are you making yourself presenter? Where are you?
Bernard, you're presenting Comcast as well next
Okay.
month.
Yeah, I called Comcast.
Okay.
They're sending me an annual report. I'm going to make an annual report and a quarterly report next month. That'd be wonderful. I'd be glad to.
Okay.
And really go into it and see what we're going to do.
Jay, sorry, but because we don't have to vote on these right now. We're just making the motions, and because of the time, can we put the motion forward and then vote on it? You can look at the details in the next
We can
day
discuss
or so.
offline, Amy. We can discuss offline.
Offline, yeah. Is that okay?
Okay.
Yeah.
Yeah,
Anybody
that's fine.
second the
Because
motion?
we want. Yeah, I can second it.
FAF, because I want to see which one's which. Is that the medium-sized company, right? FAN?
Sorry, that's.
FAF, the third.
Oh,
the third-
FAF. Okay.
The second one. The second one.
Okay, that has been sent out as well.
I'd like to make motion to get 2,000 of the Franco-Nevada.
Okay.
I second the motion.
2,000 FNV.
By the way, Adam, my SSG shows 2020 on the low P is a 45 for Franco-Nevada. I
Does
confirm
anyone-
with
Too.
Joanne.
Me too. So
It was
you might want
45.
to check.
I don't know
you
why
might wanna
it shows
check your-
20.
Yeah.
Yeah.
Does anyone want to second that motion? The Franco-Nevada one?
Yes.
I think Bernard
I'll
did.
second
I
it.
second that
did, yeah.
Oh,
motion.
Bernard. Okay, sorry. Bernard. Yeah. And simple majority by one members. Save motion. Okay. Any other motions?
Does anybody want to sell Schwab? I mean, if we buy FAF, is that a replacement for Schwab?
I think
We're gonna
we
keep
can
Schwab.
hold on to it a little bit longer
Okay.
because I would like to take a look John's SSG for last time. And
I thought
Okay.
if you want to sell a company, you should do a sell list, right?
He did.
right.
There
He
is a
did?
sell.
Oh.
John Patterson
Oh.
did do a sell
Oh,
checklist.
I don't
okay.
remember. Okay.
Uh-huh.
John,
Okay.
John, did you want to make a motion to sell Schwab?
No, I want to reevaluate it. It's going to be coming up in June.
Okay.
Due to
Okay.
I want to reevaluate it.
All right.
All right.
Yeah.
No problem. Okay, any
Okay.
other motions? Because I'd like to get Henry in here so he can, I don't know what time it is where you guys are, but it's 10:40
Yes,
my
past
time.
10 minutes.
Yeah.
Uh-huh.
Yeah.
I
Okay.
automatically fall asleep in about 15 minutes.
Okay.
I want to.
Okay, all right.
Henry.
So if
There
Henry,
was there anything about Algonquin? I thought there was some decision there to be made.
Algonquin? No.
Yeah, no, okay.
Okay, I'm gonna turn the floor over to Henry Gold, our guest. Henry, Jay, is Henry's mic open or?
He's trying to talk.
Yeah, no.
Oh, there you go. Okay.
Hi, everybody.
Hi, Henry.
Very, very interesting meeting. Enjoyed it. The stock to studies were really nice. Well done. I'm looking at it from the standpoint of a non-member to some extent, or a member attending the meeting. Is that fair?
Yes.
Yep.
Okay. When you show a form, the forms are great, but just mention what the form is, or you know, where the form comes from.
Okay. So a bit of an introduction to the form.
Well, yeah, I mean, you don't have, you know, just one sentence, you know, this this is an SSG, or the stock to study. I was nice to see you using the stock to study. But when you use any kind of form, is to let the attendees know what the form is. You know, you don't have to go into a whole lot of detail on it. Just a couple quick notes. The treasurer's report and the portfolio review could probably, I noticed at the end of the treasurer's report, there was a lot of review that might be able to combine it in that section of it into the portfolio review.
Yes, especially I think the diversification, there's a bit of an overlap between the two.
Yeah. Again, it's, you know, I'm just quickly mentioning some things. Overall, I think you guys do a really great job with it. A little confusing when you make all your motions at the end.
Yes.
When you, like, for instance, when you were doing the two mortgage companies and against Schwab, is there a reason you don't do a motion at that time?
We typically just keep them at the end and then have a discussion, but you know, that's just I don't know, that's just the way we did it. Might make more sense to do it right after you reviewed it when the information is still fresh. So.
Again, these are just, you know, these are just quick thoughts. You know, might save a little time because then you're not going back to look at it again.
Right.
I think we did that before the beginning. The reason why we decided to move it to the end, we felt it took too much time to discuss. I think that was the reason why we moved it back at the end.
Right.
Actually, I think we should try again because that makes sense that when somebody presented, let's see if we have a motion to buy the ones that we just presented for the stock studies.
And I guess, you know, there was discussion about selling Schwab because it was high. But then I noticed later on you were talking about doing another SSG on it, which is fine. But overall, you know, very, very, very good. Presenting 4 stocks is a lot of stocks to present in one night.
Yeah.
But you did a nice job getting through it.
Yeah. I have a question for you. Anyway,
Sure.
Will you sell the company if that company hits a historical high for the price? Will you take a profit?
No,
No.
I would just do what I've seen, and what I've seen, I know we used to do is still do it, is on the SSG
Mm-hmm.
at the very top of it, do your 5-year per year out expectations. And then at the end of a year or fiscal year or whenever you want to look at it, you can look at it and see if the stock is still meeting your expectations. If it's going above your expectations, great. But if it's going below the expectations, then it's time to take a look at it and figure out why. Is there a one-time problem? But no, historically, when a stock hits a high, it continues to go. So I guess I would evaluate a stock. I just do another SSG from scratch.
Right. The reason why I'm asking is we sold a company. It was hit 52 weeks high, but the SSG shows buy, but we sold it because it was a historical high. It does not make sense to me. I would not do that, but I just want to get your opinion, because today at the beginning of the meeting, we had another discussion for another company. We also talk about, oh, right now it's a historical high. We should just dump it. That's why I want to ask.
I think generally the idea is if a stock's gone beyond your expectations, just do another event, an SSG, and let's say you've had it for 2 years, then start from scratch and do an SSG on it and see where it's at.
Mm.
Jay, which stock did we sell because it was high? I didn't. Air lease. Okay, thank you.
I think we sold it because it was because of the future of the airline leasing business was in question.
Right.
But I have another question, Henry. So you mentioned that doing 4 stocks is a lot in one night. Next week we have 6, and that's a function of the number of stocks that we hold in our portfolio. We have to typically do quarterly reports and annual reports on them. Do you have any advice in that regard? Because these meetings tend to run a little bit over, and we have a lot of stocks to discuss, right? And then
I know you're almost up to your 15 minutes, and I wanted to keep you awake.
Yep. And then, on top of that, we have to do education topics because we're
right. No, I think you did it. Now I'm more confused on Bitcoin than I was, but no, that was more information than I ever knew. I appreciated it. Well, some clubs like to don't look at a stock unless the person following it feel there's been something that's changed substantially, or if the stock's not meeting the expectations or exceeding the expectations.
Okay.
I'm not sure what dictates what stocks you're looking at.
We do every quarter we'll when they have new earnings and so on, we'll do a quarterly report, and then we do an annual report. So for each stock, we're looking at it 4 times a year.
Boy, that's a lot.
Yeah.
But if it looked like you had around 16 stocks.
Yeah, 15 or 16.
14.
Okay, 14. So you got 1 stock for each person or so.
Yeah.
In general, so maybe you could save some time if the person following the stock just gives a report and says, they're pretty much on track as to where we projected they would be. A couple sentences or anything substantial, and not go into detail unless there's been a major change.
Yeah, that makes sense. Okay. All right.
I have a question. So with Bitcoin discussed, is this something that would fit into the portfolio of this kind of club, or is it just a kind of interesting topic.
My opinion, I think it's an extremely interesting topic. I mean, considering what's happened.
So,
Go ahead.
so Henry, there's nothing wrong with investing in gold, is there?
No, that's my last name. I'll take all I can get.
Goodness.
As a club, well, you are doing it through companies is probably the better way to go for a club. I mean, otherwise you could just buy GLD and go along with what the price of gold is going to do. Because then you're buying an ETF that actually owns the gold.
Right.
Do other clubs
Like any other
invest in
industry,
ETFs or?
you're going to have some companies that are going to outperform the industry. So I think it's something to look at it. But again, we're looking at growth stock, so it's worth weighing. Now but you guys cover an awful lot of material in a reasonably short period of time, which is a challenge to be able to do, and you do a good job with it.
Thank you.
Yeah, we need to find a different approach, I think, just to try to maybe cut down on the meeting time a little bit.
Well, I think you could save yourself a lot of time if you don't get into details on quarterly on companies unless there's a significant change.
Yeah.
You know, if the company's doing, if companies you've had it for 2 years and it's meeting that 2-year projection where you think it should be, and there hasn't been any substantial change, then a quick comment to that effect would suffice.
Right. No, that makes sense. That makes sense. Okay. Anything else, or before we open it up to our guests?
No, go ahead.
Okay. All right. Well, thank you very much, Henry. That was good advice. Thank you. So we'll go to the guests now. If you have any comments or suggestions for us, first up is Ellen McCrory.
First, Hanny, can I adjourn the meeting and then stop the recording?
Oh,
Okay.
yes.
So,
yes.
Okay, meeting adjourned.